lot size and risk management. This is a big one. This is almost the most important one. But how do we actually apply this to our trading to assure that we stay within proper risk management profiles? Okay, so just looking at this snippet of the chart here, let's say we're going on my model here, right? So we see validation of this point right here, this swing point. We see this swing point get taken, okay? And then we see our internal market structure shift, right? This is my model. This is my everyday trading model. So I'm going to place my long position here, and I'm going to factor in the ATR, whatever, and go for my 1-to-1, right? As I do, in and out. But how do I know how much money to risk? How do I know how much money I'm going to make? And for this, it's a fairly simple concept, but not a lot of people are actually aware of this or apply this in real time. And on lower time frames, it can be very hard, and when you're not placing pre-calculated limit orders. So here's how to do this in real time. And I'll even show you how to do it live trading on the 1 minute, how to get that calculation very quickly, right? So we have our model here. Everything looks good. We have our stop. We factor in our ATR. We have our true stop. And it says 6.7 or 67 over here. This means our stop is 6.7 pips. And for every 1 pip, 1 whole pip, it's 10 ticks, right? So if we have 67 ticks here, and let's say we want to risk $100, right? We would pull up a calculator. We would do $100 divided by 67, divided by the number of ticks, right? And this number that it presents us is 1.49 to risk that $100, right? 1.49 lots, standard lots, to enter here with our stop loss here and go for that $100 risk, right? Very straightforward. But if the markets are moving very quickly, you have to be a bit proactive with this, right? So what I would normally do, if I see all my setup here, I see the validation, I see the sweep, and I notice this point generated here that looks like this candle expanding and flickering around could close above to give us that internal market structure shift. I'm going to quickly just kind of get where I want my stop to be, factor my ATR, and I'll quickly just throw the long position where I think it should close, right? This might not always be 100% true because candles can be unpredictable, and this close I think would close here could end up all the way up here, right? So I place my long position entry right around here, and then I'll quickly pull up a calculator and do the math on that. The formula is very, very simple, right? All it is tick value divided by risk in dollars, or whichever currency you're trading in, and that will give you the lot size. That simple. The tick value, which was 6.7, divided by the number of risk, or the dollar amount I want to risk, which was $100, right, gives us the lot size. And it's that simple. That simple. Calculating lot size is one of the things that will save your consistency in trading. A good rule of thumb while trading is that you never risk more than 1% of your account. Never more than 1% risk. Why is that? Why do we only want to risk such a small number, right? And all it boils down to is consistency, right? This is the name of the game, being consistent, right? Consistency is the number one. When you're trading, you don't want to enter randomly. You don't want to have random stops. You don't want to have random lot sizes. You do not want to be risking a random dollar amount just because you feel like it or your emotions get in the way. You want to be consistent, right? And if you lose a trade and you risk, say, 10% of your account, then you're gone 10%. And not to mention the psychology that comes along with that. If you risk that 10%, you will be staring at this trade and you will be waiting for it to hit your stop loss or waiting for it to hit your take profit. You'll increase your stop, you'll get break even. Bad things can come psychologically from a higher amount of risk, right? And we want to save ourselves that hassle and that mental stress, right? So we be consistent with our low risk management, right? And one thing I notice is people who trade, they like to always bring their stop to break even right when they see a small amount of displacement away from their entry point, right? And if you are trading and you're going for super small risk to reward profiles like this, like you're going for like 4 pips, 40 ticks, then that might be okay because you are just trying to get these few candles to move upwards, right? What I do with my trading is if I see something like this and I enter my trade, I will stick to my parameters no matter what. I don't move them. I don't go break even. I let the market play out according to my strategy, according to the math behind my strategy. That's what it is, right? It's all mathematical based. So if you have, say, an 80% win rate, but you constantly move your stop to break even, that can drastically affect your win rate. And you don't want that. You want the math to support your trading. That is why you're trading, is because you have a system that you have tested that you know will work, but you have to follow the specific parameters in accordance to your system, right? Risk management and psychology are very, very important, and I hope this helped.